audio system again for everybody, so we get that. But let us stand and say the Pledge of Allegiance, please. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you so much.
Right, I like that better.
All right. Melanie, would you like to just briefly explain the system? I know you've been going around and doing it, but.
Absolutely.
Okay, so the council microphones are always on. If you'd like to mute yourself, just press the push button and hold it, and it will mute your microphone. The speakers in the ceiling have been disconnected for the front speakers, so the counselors may not hear things through the speakers quite as much, but you should be able to still hear each other just fine. If that does become a problem, let me know, and we have some other speakers we can install. But it was causing feedback to have those speakers activated. So there's a speaker out in the lobby that works, and then the speakers in the back of the room work just fine as well. And then we have microphones for our attorney and our village administrator, and then for our guests as well. So just make sure that the microphone is about the distance of your thumb to your pinky from your mouth. And same thing for the microphones here. You might have to pass it around during our work study so that everyone can be heard on our Zoom.
Thank you. All right. First of all, I'm going to have our governing body, Phil Waldman.
Here.
Councilor Murray.
Here.
Councilor Burkett.
Here.
Councilor Knight.
Here.
Councilor Lucero.
Here.
Councilor Parker.
Here.
Thank you. And I would also like to welcome our newly elected officials who I hope have joined us. I think maybe Councilor Alsabrook, there is a spot for you up at this table if you'd like, sure. So maybe you would like to introduce yourselves to everybody. Let's start with Rick Miera at the end there.
Thank you very much. Rick Miera, new elected council for District 1.
Thank you. Good to have you. Thank you.
Very much.
John Alsabrook.
John Osborne, District 4 council.
Thank you. And then we have Councilor Knight, who's re-elected, and the rest of us are familiar faces. So thank you for being here with us tonight. What I kind of wanted to have this for was to have sort of a one meeting where the old faces got to see the new faces and a little bit of information about going forward. First thing we're going to have is a presentation and discussion of future budgeting by Brad Angst from Stiefel Public Finance. So, and then I believe we will have a little bit of a item from Jill Sweeney. Then I think we're going to have a discussion on spending of our LGIP funds. And then I believe, unless there's a different order you want to go in, Ron, we're going to have a little preview of our budget here. Does that sound all right? Okay, great. Take it away, Mr. Angst.
All right. Pleasure, counselors and mayor. Good to be with you. This is, I'm Brad Angst. I'm a director with Stiefel Public Finance. We have an office here in Albuquerque. I work with John Archuleta as well, the open person. And we work with cities, counties, school districts across the state to help them with their project financing. And so how that fits into your budget as you begin to think about those steps is really looking at some of those larger capital expenditures that you have. Is really when we get involved and we help you raise funds for those. And we help structure it in a way that you can afford, that is suitable for the village and for your credit profile, what you all are comfortable with, and in some cases what your voters are comfortable with. You know, what we have coming up on your agenda here later tonight is a general obligation bond, and that was a bond that was voted by your citizens. They decided and approved, you know, going out and providing these funds. So that's just a little bit of background, but we did prepare a presentation to go through. You all will be a little bit familiar with this format, but we wanted to take some time to help get the the elected officials, the newly elected officials up to speed, and not only on the current debt profiles and the plans and things that are going on today, but a little bit of the historical information as well, and how the village and its voters implemented a capital program and financing plan back in 2018 that was really set up to be able to be renewed and allow for future projects every couple of years. Okay, so in the presentation, we'll flip to slide 3 to get started. So this is a look at some of the tax rates that are implemented here in the village.
Can you help me with what exactly does slide 3 look like? For
Yeah, it's the bar chart.
Okay,
It's
thank you.
the blue and green with the table on the bottom.
This is what it looks
Sorry, I know
Right.
that the staple may gotten right on that area. And please, at any time, guys, this is I'd like to be a conversation, question, answers, discussion. So please point out any questions that you may have. So villages and municipalities within New Mexico have a few different options for producing tax revenue. And what you're seeing here is the mill levy that's applied against your property and all the property, both commercial and residential within the village. And so you'll see this is a look over the last 8 years or so, starting at the bottom left. The current year, you have a 3.8 residential operational tax levy. And so what that means, the 3.8, that's $3.8 per $1,000 of assessed valuation. So what does that mean to a homeowner? So if you have $100,000 market value house, the way we get to the taxable assessed valuation in New Mexico is we divide that by 3 on a residential. So you have a $33,333 taxable value. Then you would divide that by 1,000. So you have 33.3 times this mill levy, so 3.8, and you get approximately $110 for a $100,000 house for that operational mill levy. So that,
Just a quick question. Yeah,
Do you, Councilor Wolman, and I know we haven't been in person in a long time, but would you remember to just ask me so I
I'm
can
sorry.
recognize
Yeah,
you? Thank
yes.
you. Otherwise, I don't know. Councilor Wolman, please.
Thank you, Mayor. You mentioned appraised value, and then you mentioned market value. And this is not the assessed value from the county assessor, right? This is a fluctuating market value.
no, it's the taxable assessed valuation is what the mill levy is going to be applied against. And so
From
that
the county
comes from
assessor.
the assessor's
Okay.
office.
Good, thank you.
Okay, so then you have your non-residential rate there. You can see it's a little bit higher for some of the commercial properties. And then the next column, the debt service column, and that's where I really work with you all and try and keep a nice steady rate, keep the tool available to you so that you have the ability to do whether it's maintenance projects or new projects, or as the voters wanted to do with these real estate acquisitions or the conservation easements that you did all recently. And so back in 2018, the voters said, yes, we're okay with a 2.4 mill levy in order to take on that debt in this program moving forward. And so our goal is to keep that as steady as possible at the 2.4 or lower, balancing that with your valuations and that go up every year. We try and structure your debt payments so that the appropriate mill levy is in place and that stays as steady as possible for your taxpayers. Together, those different components bring the total tax rate here on the residential side to approximately 6.2 and non-residential of 8.8. going to flip to the next slide. So the mill levy is one component of that tax revenue. So it's a function of the value, taxable assessed value multiplied by the mill levy gives you your tax revenue. So this is the other side of the equation, the assessed valuation. You'll see going back to 2014, the village has had some pretty steady growth, very consistent until just this past tax year. There was a bit of a decline. A lot of that was due to COVID, the pandemic, the recession, and lack of commerce that happened shortly after. But we did see a little bit of decline in the property values there. It is expected to come back up. In talking with Michael Cisco, the real estate consultant that works with the village, he estimates and believes that it's going to be recouped. That full 7.9% decline that happened, he thinks it's going to be about the same return, if not a little bit better this cycle. In the top
Mayor,
right,
could I ask a quick question? Sorry to interrupt.
Sure.
Um,
Councilor Burkett?
so I don't know that I understand that decline because again, just to kind of go back to Councilor Waldman's question, this is assessed values, right? And I know I certainly didn't see a decrease in my taxes, my property taxes and my assessed value. And I don't know how the economy affects the assessed value because they go up every year pretty routinely, correct? So this is like a 10% drop on residential. I'm curious where that's coming from.
I'd have to research that maybe with the assessor's office, maybe with Mr. Cisco to get some more definition behind exactly what caused that.
Because market values, I mean, are through the roof. So those would be significantly higher. Assessed values, my understanding was they climb pretty much consistently. So I'm very confused how we lost $32,000 or $32 million in residential assessed value.
Certainly something we can follow up. We've asked that question of the assessor's office just recently as we went through your loan application and as we're working on this new GO bond. That was a question that arose.
Okay.
I can say we didn't get much of an answer from the assessor's office. Certainly research that and try and get some more.
Thank you.
Info. Yeah, absolutely. So in the top right-hand corner, this is what the state of New Mexico statutorily says that any municipality in the state can bond. This is your bonding capacity. And they say you can go out, you can borrow up to 4% of your assessed valuation. And so that calculation is there on that top line there in the top right. When you multiply the 4% by the approximately 400 million of a tax base, you actually have the capacity to go out and borrow for up to 15.8 million in GO bonding capacity. That has to be done though with the approval of your voters. You as a council can't do this on your own. That's a decision your voters make. If they do decide to do that, then you all oversee that process, make sure that it's done in the right way, that you have the right type of debt product and get a good interest rate there, at least on current market. So when you look at that amount of capacity and you back out the current amount of bonds that you have outstanding, which is 4.6, this gives you your current additional GO bonding capacity, which sits about 11.2 million. And then on the bottom right, we just show how that full capacity is recouped over the years. As you make your bond payments on an annual basis, you'll see that you recoup anywhere from 900,000 to about 700,000 of capacity each year.
Mayor, this is Councilor Murray.
Sure.
So when you say outstanding general obligation bonds, that doesn't include any future bonds that we have before us? Any bond issues?
No, sir. This does not include the future ones at this time.
So we would add probably another 2 million to that if we do that thing tonight?
No, that's already
That's in here.
Is it?
already incorporated.
baked in.
Yes, sir.
Okay.
But also it depends too, we don't want to get too much further than that 2 million or so every 2 years, because then our mill levy rate's gonna go up.
That's
and
right.
The taxpayer's gonna pay more.
That's right. You all committed to the public that you'll keep it at 2.4 or lower. You can't keep layering it on indefinitely or with a fast frequency, or it's gonna push that mill levy up. The 1.9 that you're doing and considering this evening, that's the last of the voted authorization. You can't issue any more general obligation bonds unless you go back to your voters. Okay, I'm going to move to the next slide, which is page 5, and this is a recap. It's a look at all the voter authorized debt that has been approved over the last 4 years or so. And beginning with the 2018 election that really kicked off this new capital program and financing program that you all took on. So the first 4 questions came with that 2018 ballot. It was in total approximately 4 million of debt. And it was for various items, including some park improvements, some public buildings. You had some road and streets and roads money included in that. And of course, the conservation easements as well were included in that amount as well. And forgive me, that was 5.5 in total. In 2020, you went back to the voters, asked them to renew the program. And they approved another 4 million at that 2.4 mils. 1.5 of that was for the planning design, of course, the ultimate construction and maintenance of some streets and roads. And then 2.5 was done for parks and rec. And of course, the 1.9 here is going to be considered here to be finishing up, I believe, the rec center. Is what that's going to be used for. We flip to the next slide. Okay. Thank you. Okay, this is a look on page 6 with the green, blue, yellow, orange table here. This is a look at your existing debt portfolio. These are the bonds that you have outstanding. Going back to the 2018 on the left-hand side, the 2020s, 21 and 21B. We list out the original par amount. I'm going to look at this one on the left-hand side and just go from top to bottom for you, what we do here. So there are general obligation bonds issued in 18. We have the what we call the dated date. That's your closing date. So that was in November 16th of 18. The original par amount, that equals the principal amount that you've borrowed. That's bond terminology. The current par amount or principal amount remaining outstanding, 855,000. Then we put enhancement as the next category. You have the option when you sell bonds to get bond insurance. There's a few different companies that can provide that. You pay a premium up front, and it can afford you sometimes a lower interest rate. So we do that break-even analysis each time we go out and consider a new bond issue. And then it has call provisions. Call provision is your ability to prepay bonds and potentially pay it off with cash early or maybe refinance into a lower interest rate. You'll notice that none of your bonds have that, and I can explain that now. Typically, the point in which you can do that in the municipal bond market and even with direct loans is at 10 years. 10 years is when investors will give you that date, the ability to prepay. They've been able to recoup enough of their interest and feel like they've made enough back that they give you that option. If you go any shorter than 10 years, it's going to cost you additional a higher interest rate that you pay for your bonds. Most of your debt, all of the GO debt is done through the NMFA. They stay consistent with the bond market and investor market. And so we've gone out for less than 10 years on each of these bonds. You have a pretty rapid repayment. The state of New Mexico allows you to go 20 years. So you've been cutting that in half. That reduces your interest cost, let you pay them off early and recoup some of that capacity as well.
Any questions? Go ahead.
All right, I'm gonna go to the next slide here. Page 7. All right, this is when we get into a little bit of the current bond you're considering, and then we're looking forward. So I'm gonna orient you here with this this slide and this table, just moving from left to right. We've got the future repayment years there on the left-hand column, going out to 2036 is what this final maturity would be on some future sales. We've got a growth factor that applies to your property valuations and your assessed valuations. You'll see we've got that decline from this past year. We've got a little bit of a going back at 6% growth next year, 2.5% the following year. Then from there on out, we have 0% growth. And so the lower the numbers you all see on these growth factors, that's the more conservative we're being. That means we're not going to have higher payments based on a growth of your AV over the future years. We're not leveraging you up based on a future size of your tax base that maybe hasn't come at this point. So when you see the lower growth factors, especially in the long end, we can't predict that far out. That means it's a more conservative look. Next column is the assessed valuation calculated off that growth factor. And then we have the existing debt payments in that next column and the anticipated mill levy that it's going to take to repay those payments. And so you'll notice in that anticipated mill levy column, it's 2.4 this year, but it drops off next year and it declines a little bit each year after it. That's what allows you to layer on these new projects with keeping that tax rate nice and steady for your taxpayers. Okay, the next section to the right of that is the future or proposed debt issuances. So the one with the orange box, that's the one you're considering tonight, 1.935 million. We have the repayment schedule there. And then we have the total payments at the bottom. And then what we've done is we wanted to make sure to leave you all these tools and flexibility to be able to do this in the future. And so we also wanted to prove that up. So you'll see another 2 million issued in 24. That's assuming that your voters approve it at that date. 2 million in 26, 2 million in 28. And then that next column aggregates all those payments. On the very right-hand column, again, we show that we can accomplish this, at or below that 2.4 mill levy level.
You actually-
Yes, Councilor Pat.
So not looking at the current election that just happened, but the previous two elections, we had bonding of 5.5 million and 4 million. So these $2 million estimates over the next 3 election cycles are significantly lower than what we've been doing as far as bonding elections. For a village this size, is 2 million every election enough to meet our needs or the typical needs? And I don't know if we go further back into history, what we were typically bonding per year, but this is 50% of one year and 35% of the previous election.
Part of why you're able to afford the larger amounts on the front end is because you hadn't been implementing that 2.4 mill levy. You didn't have any debt service using up some of that to start. So you can always afford a little bit more at first, and then you layer these on. It's part of the answer.
Okay.
Secondly, you at that 2024 election, you would probably go out and ask your voters for 4 to 5 million.
Okay.
The approval once your voters approve, it stays good for 4 years before you have to sell those bonds. So you have 4-year window after voters approve. We'll continue to redo this, refresh it as we move on, as your new valuations come in. We'll fine tune that to know what the right amount is. But we believe, based on today's numbers, being conservative with the growth, we can accomplish 2 million every 2 years.
Okay, so if we did 4 to 5 million in 2024, we would then probably skip another election in 2026 and just fund those over those.
Yes,
Do you
sir.
guys have any sense what our average GO bonding has been longer time range back than 3 elections? I mean, I don't, but 2 feels low, but the numbers show that that's our max right now.
And Councilor Burkett, also keep in mind that at this juncture, given where we are in the state of the world, in addition to GO bond funds for infrastructure, we also have ARPA funds and funds coming in from other buckets that have to be spent and combined with this. So that, at least in the short term between now and 2026, adds another several $1 million to that package and gets you probably more closer to what your expectation would be.
Right, and this doesn't factor in varying interest rates at all either, right? Because I know the 2018 bonds were somewhere in the 2 to 3%. The ones now are in the low 1%. So our capacity is significantly higher if we stay in the 1% range versus the 3% range. What does this assume as far as an interest rate?
The future, the forward looking,
Yeah.
we use historical averages.
Okay.
Like a 10 to 20 year average. So it's not the low rates that we had last year. This 1.9 today is close to market rates today.
Yep.
The ones looking forward are using historical average of the 4% range.
Okay.
So, and then, I want to point that out or add on to Jill's comment though. This is just one tool that you have. When you look at your budget as a whole, and you think about the maintenance of your assets, of smaller projects, you may accomplish that through your actual, your operational budget, which is paid for from GRT revenues, some of that operational tax rate that you collect. This type of bonding and borrowing is meant for your larger projects that are a little bit tougher to accomplish through an annual budget. So, okay, I'm gonna move to the next slide, page 8. This is really the same data and information that I just presented on the previous page, looking at it a little different way. So the dark blue bars on the left and to the bottom, that is your existing debt profile. And the orange would be the new bond that you're considering this evening. And then the green, blue, and yellow are the future ones. And so this is just a graphical representation, a way to look at how you can layer on this debt, these projects, without increasing the debt burden on an annual basis, on a mill levy or tax rate basis, and really, look to accomplish some big things over the coming years. I pointed out there too, I put a highlight, you'll see at the top of the 2025, I have a circle with an arrow going back. So the way we identify when you have the elections is to see when your debt portfolio has these step downs in payments. That's when you can layer on the next one without an impact to the current mill levy. And you go to a year before that. The village is still on a special election calendar. So 2024 is when we would target that next GO election. Okay, to the next slide. So that was really a recap of your general obligation type bonding based on your property tax base. This is a recap of the gross receipts tax bonds. You can also leverage up and use some of those excess revenues from GRTs in order to do projects. And so back in 2014, the village went out and did approximately 3.4 million of GRT bonds. The final payment on that is 2033. And then in 2020, we did a hold harmless receipts tax refunding and revenue bond. So refunding in the bond world, that's the same as a refinancing. You typically do that for economic savings. And so you had a little bit of new money and also refinancing wrapped into this one. That one was a $1 million transaction. That one, the final payment is 2035. That's the debt portfolio, and I'll pause. I'll see if there's any questions or discussions you might want to have before I give you a little bit of an update on the bond market, the capital markets, and what we're seeing as far as interest rates. Any questions at all? Any discussions you might want to have?
Mayor,
Yes.
just as a question. Brad, we had a discussion, and I bring this up just because we're talking about the LGIP funds. We had a discussion earlier with you and Jill about using some of those funds to pay down some of the bonds that you talked about earlier as far as during the call situation. And so that was an example that stuck out to me. You didn't think that was necessarily a good idea to do that, but was that an example of what we would be talking about during the call?
It is. So there's a couple of strategies you can have. Maintaining a cash balance to certain levels is always a good thing, in my opinion, in the rating agency's opinion, and in your creditors and lenders' opinion. Of course, y'all are stewards of the public's money, though. How much the fund balance is too much. We typically like to see 25 to 30% at a minimum reserves of your annual budget. So 3 to 4 months worth of expenses. And if you did have excess funds, if LGIP was exceeding that, the village thought that you wanted to retire some of your debt, even though you don't have call options, you can still put money into an escrow account that would defease your bonds. Defease is a legal term that essentially allows you to take that off your balance sheet, off your books. So you could, if you wanted, put some of that money into an escrow fund that earns a little bit of interest. It would pay off some of your maturities as they come due. It can still save you some money that way. Let me take a look at the gross receipts tax bonds on page 9. The 2014 bonds actually have a call date coming in 2024. So again, that means here in about 2 years' time, you can actually pay off those bonds and remove the interest component to it. If you wanted a cash fund and make those payments, or if interest rates were low enough at that point, you could refinance, refund those bonds into a lower interest rate and get some savings. Yes, sir.
Do you have any idea what this gross receipts tax on for 2014?
We can, I don't know offhand, sir. That's certainly something. Do you know it?
Mayor,
Yes.
Mayor, we do have the bond transcript and I believe the official statement that outlines the purpose and the terms of that financing. We're happy to follow up.
Okay. Yeah.
It predates us, but we do have that available.
But it doesn't predate us, but we can't remember.
John, my business partner, John Archuleta, actually worked on that with you all.
That's right. You're standing right there with the podium. I can't remember what the 3 names. We also did the other one too. It was 900 plus down.
darkness, full darkness. Anything else? Okay, did you want to move on to the?
Okay, I'll give you a brief update here. I'm sure you all have heard about this in the news, but no shocker, interest rates are rising. They have risen pretty substantially. Good news is that we still are lower than historical averages. We were near at all-time lows over the past year to 2 years, even though we've come up almost a full interest point. And so the borrowing costs, it's still below some of those averages. So I'll show you a couple of these data points, which I think did a good job showing what I just explained. First off, the top left chart on page 11. This is a look at AAA credits, so the highest credits that you can get, and it looks at the current spot rate at any one point over the last couple of years. So you'll see back in January 2020, it was started, that top line represents a 30-year borrowing. That was about a 2%. It spiked there in March of 2020. That coincides with COVID and the pandemic. And then they came back down, and you'll see here, as you move to the right, they've come up, and the AAA is now at about 2.33 for a 30-year borrowing rate, and the 2-year is about 1.39, and that's actually even higher now. We've got a very flat yield curve. The 30-year borrowing cost is not much more than a 2 or a 5-year borrowing cost right now. There's only, I think, 50 to 60 basis points separating those. The basis point is 0.01 of 1%, so 50 basis points is 0.5%. So, that tells you a lot of money is flowing into the short-term bond market. That's a flight to safety to some degree. People concerned about potential recession because of some of the inflation that's going on, the war, the continued supply chain difficulties. So we do expect interest rates to continue to rise as of now. They're still in a pretty good spot looking historically compared to averages. The bottom left is another, I think, good graph. This shows where the current interest rates are today is represented by the lines, and then the bars are is the range over the last 10 years of where that rate has been. So you can still see we're in the bottom half of that range, long end of the curve, about halfway point there into years 1 through 10. Moving along to page 12, I mentioned supply and demand. We, for 42 straight weeks, going back over the past year, saw inflows into municipal bond funds. And so what those are, your retirement accounts. If you're investing in a bond fund that's focused on municipals, that money flows in to buying the village's bonds, buying other cities, counties, school district bonds. So 42 straight weeks of that. And then starting in January, in that bottom right-hand corner is what I'm describing here, is when we saw some outflows. So people taking some of their money out, holding it in cash. The demand weakened a little bit. That leads to a little bit of a rise in interest rates as well. There's still a lot of money out there, still a lot of investors, as I mentioned, looking for the safety of municipal bonds. There's a little bit of advantage, a little more interest rate than they can get when they buy federal treasuries. So there's still quite a bit of demand, and we expect to be able to tap into the capital markets and access this type of funding financing should you need it. And then lastly, on the last page here, some interest rate forecast. Our firm has, as John and I here that work with you directly, we have a tremendous amount of resources, including an in-house economics group, analytics. They're estimating here in the top right hand is what I'm looking at as far as yield curve projections and where they're going to go here this year. You'll see the current Fed funds rate of 0.5%. That was just increased to that amount this past week when the FOMC met. We're predicting that it's going to go up a full percentage point by the end of this calendar year on the short end. You'll see on the 30-year, it's at a 2.45 currently. Only expecting that to rise about 14 basis points. So again, the short-term cost of funds is going up. Long-term is staying flat. As long as we keep a little bit of a incline, that's good for the market, good for GDP and growth. When you get a flat yield curve where interest rates on the short end of the curve are the same as the long end, that can potentially be a warning sign of a coming recession. So that's the conclusion. Be happy one more time here. Happy to field any questions, have discussions that we may all want to have.
Well, thank you very much.
My pleasure.
At this point, Jill, did you have anything that you wanted to add? I do know that we also want to talk about the LGIP, so go ahead. Fire away.
Sure. Mayor, councilors, councilor-elect, I'll be very, very brief, and hopefully we'll have other opportunities to dig into some of these legal aspects of your bond program. My name is Jill Sweeney. I work with Sherman and Howard in Albuquerque office. Live right up the hill of Alameda. My job as your bond counsel is to advise you before, during, and after your bond process. Work closely with Brad and others. So during your election, to help you craft your election questions, determine what projects are eligible, determine on an ongoing basis, question, what questions you may have, and answer questions you may have on expenditure of bond proceeds after the bonds have been issued. During the process, work on your bond disclosure and tax matters, those sort of the three legs of the stool of what we do. And then after, also work on ongoing compliance, both audit and continuing disclosure into the market to the extent that you have public resale bonds. And as Mayor Lex pointed out, you do. Also work with you on other types of financings, whether those be Finance Authority, the USDA, other resources, and of course, right now your ARPA funds, and try to work with the team to look at your CIP program, your capital needs, both now and into the future, and what buckets are available to finance those, and how those tools can work most effectively and efficiently together for the benefit of the village. So with that, one of those tools is the LGIP fund, which we have worked together on and done some research into the history of those funds, and I had some discussions about their availability and the choices that the governing body has for those. So look forward to speaking with you about the current issue during the meeting, but for now, let's move on, and I'm happy to stand for any questions or assist in the discussion on the LGIP.
Thank you so much. Ron, are you going to head up the conversation on the LGIP?
I will. I think in your secondary packet there, you've got the work study agenda. You've got the end of month statement for February for the LGIP. You've got, should be a letter from the state of New Mexico on March 3rd.
This one, yeah.
Let's see, which one?
You've got a letter from
2000,
Vicki
the 530.
Haynes, Chief Investment Officer from the Treasury, talking about the LGIP. And then you've also got the resolution that the governing body passed on July of last year on some very minor expenditure requirements on there. So some of the questions that have come up is that the resolution that the governing body passed is fairly explanatory. And you can change this, the governing body can change this at any time. But the two key provisions in here are that it's 50% of the total amount of the pool should remain in the fund. And the second one is that money spent from the pool shall not be spent on payroll, recurring expenses, or any subscriptions. And I think that's self-explanatory. We don't want to use the fund for paying bills with as a recurring expense. We don't want to use the fund for making payroll. And subscriptions are subscriptions. You know, that could be anything from a magazine subscription to something that you're paying for Comcast services or something like that. But the key thing here is that this is a very quick money. If the governing body decided to spend something out of this fund at a council meeting, they could actually have that money in hand within the next 48 hours after that. So it's very fluid. And as Jill mentioned, we hired the McCard firm to do a kind of a forensic audit on this fund when we discovered that we had almost $5 million in it. And what we found is that it was accumulation. And what was interesting about it is that I know the mayor asked and I asked around town, how did this money acquire? And everybody kind of scratched their head and said, gosh, we don't really know. And so we found about 200, I believe we found 250,000 thereabout that was for, I believe, some fire equipment that had been paid out of there. And we were able to say that that was money that we could justify that it was in there, that when we look back, what we were trying not to do is go ahead and start spending this money and then finding that it was obligated somewhere else along the lines. The good news is what you see is what you can get. And that's that money. What we saw when we first got into this, when Raina and I first kind of started scratching our heads, it was acquiring a large interest every month. It was up in the amounts of thousands of dollars a month that it was acquiring an interest. And since that time, because the interest rates have come down, it's drawing almost hardly any interest, as you can see. So, you know, that's the nuts and bolts of the LGIP. Again, you can change the resolution, and the governing body can change the resolution any given time to move that 50% figure up or down. And then if you do decide to make an expenditure out of there that is within the requirements that you have, you can get the money almost instantly.
Yes, Council Woolman.
Ron, if you were to take the 50% of this, the 2,180,000, and combine that with the reserves that we have to have state regulated reserves, what percentage would that equal? Do you know?
No,
what
I
the
think our
total-
reserves are required to be 12% or something around that figure. Is that correct?
Yeah.
Around 12%.
Okay.
Is that correct, Raina? Yeah.
And so it's around 12% or at 12%. You could do that. I'm not sure where you would be headed with that.
No, I'm just wondering that what the total amount would be if you take the 2.1 plus the 12%.
Well, our current budget is $5.9 million, almost $6 million.
Okay, so
And so if you take 12% of
that's
$6 million, you know, you've got about 72 something.
720,000 or something.
Yeah.
Okay,
So you had 720,000 onto
2.1.
yeah.
Okay.
I think I can maybe see Mr. Ank's hair going on fire though, because he was suggesting that they like to see 25 to 30%, 3 to 4 months of operating expenses minimum.
So it sounds like we have 50% though right now with the 720 plus 2.1 that we're keeping in LGIP. We have $3 million on a $6 million budget. So we're twice what they recommend. And with inflation, what it is, and our interest rate, which is almost negative, we are losing cash value every day that money sits in there and we don't do something with it.
Right. So we've got, I mean, definitely room to do things.
Yeah, I mean, certainly we don't want to be hasty, but every day we sit there with, it's movability of those dollars is decreasing, or the amount of dollars we can do with them.
Any other questions,
Thank you.
Councilor Walden?
No, thank you.
Anybody else have questions about the LGIP? So yes, I mean, it's a good question for all of you going forward. You've got some money. So now that, and that's always harder, right? From when you were in the state legislature, always harder when you have money to send people on it. You got to figure out what to spend it on. Okay. Sure.
How safe is that money for
That was the first question that we asked, because as future Councilor Mira would know, that in tough times, the legislature is always looking to take money from wherever they can get it, cash balances or what have you. And so when we started looking at that, that was one of my big concerns, is the legislature would come hunting for it. And then we talked to the municipal league and we talked to Jill and her folks, and it was made the decision that keeping it in the LGIP is the absolute safest place we can keep it, rather than putting it, spreading it around in banks all over the state. So it's, from what I've been told by the municipal league and financial experts, is by far the safest place, and the chances of it being clawed back are almost nil, especially at this point where the state is in such good financial condition.
Second, it's not really a question, it's a comment. Having this money available, really cash, means that planning and design can be done very quickly. And you can have a shovel-ready project. You can go to the legislature, either state or federal. Our infrastructure people have all this quote,
Right.
cash. And perhaps leverage smaller amounts of iron, a couple, $300,000 to $2 or $3 million in partners.
That would seem quite reasonable. And I think there's going to be lots of opportunities for trying to leverage monies and trying to find the right buckets, which everybody knows it's going to be, it's not going to be totally simple, but if we're on the ball, the village should be able to get quite a bit of funding for some of the types of infrastructure projects we're looking at. If we're smart.
Rick knows better than I, legislature likes to pay the last dollar. Ladies sit out there and cook good.
Yes, I know.
But if you have the project ready, they're paying the last dollar, it's a lot better. Money comes in from the legislature, it is spent.
Matt, Mayor, on that point, is that with that money, you could do a lot of that pre-planning by the time you get up there. So they say, as we said, it's shovel ready to the point that you've already spent your money. You feel obligated to the fact that you're going to be giving us some of that money.
And when we were, and I think everybody on the council knows this, when we were trying to get a hold of some of the money that they were telling us was going to fall through the ceiling, when we talked to the 3 czars appointed by the governor, we kept hearing from them, where's your plan? You have a plan? And you're like, ugh. So that's part of why this seemed like a good idea tonight, to kind of really get people thinking about, well, wait, we need to have a plan. We need to show a plan. If this is a priority of ours, we can spend this money for the good of the community, and we can leverage it to a lot more dollars. So it's a good thing, but we're in a position now where the village maybe needs to be a little more sophisticated and recognize that the ICIP outlays that we get, $200,000-300,000, they don't go anywhere for us. You know, they're good for getting vehicles, maybe, but other things not so much. So any other questions? We are, all good things must come to an end. I know that we have our GRT, I think the latest GRT report, Ron, is that what I'm holding?
That's right. That Raina passed a new page out because in the printing process, FY22 got cut out,
Okay,
and it's the star of the show.
Our GRT is, I'm correct, aren't I? It's looking excellent. Excellent. I don't want to say for sure it's beer drinkers, but we are definitely, our GRT is seeing a bump. And how much of our budget currently is GRT? Comes from GRT? It's a big number. Yeah.
Mayor, this is Councilman Murray.
Yes, Councilman.
And also, if we could get a pie chart of how the GRTs coming in would be great to see what sectors we're actually getting money from.
I don't think we get that visibility. I don't think we get visibility to the numbers, let alone where it's coming from, do we?
We don't get as much transparency as we'd like on those issues, but to the extent we can, I think Raina's looking up that number for me, but it's been interesting that they're not that willing to share that information. But, we might be able to get.
Well, if 90% is coming from ex novo, I'd like to know.
You want to buy stock?
Yes.
Councilor Waldman?
What was my question? Oh, do we have any further clarification on the federal money? If it's going to be primarily water, wastewater, broadband, and then other, is that pretty much where we are?
Yes.
Counselor, with the, we were discussing this earlier today, and we were being very careful and cautious, and we're going to get new information in the next 2 to 3 days on how to do it. Because the way that we read the format for that, a lot of it is for public works activities, water and wastewater, but it's also very vague. And so we're going to get some more clarity on that. Our concern has been that we don't want to go out and spend money and then have somebody tell us 6 months later, oh, sorry, give us it back.
Yeah.
And if you read in some of the things that are happening in the media, you'll find that there's been some concerns early on that some of the money is just being totally corrupted already.
Huh.
And so they're being very cautious, and we're being very cautious too. But Raina and Tanya have gone through some training in the last week on how to access this money and draw it down. And so we're going to further that and get into the website to start doing that in the next few days.
Are they making expenditures already?
We've got the money. We have the money. So now we're just getting ready to start drawing it down.
Which money?
The federal money that came in, the American Recovery Act.
Okay, I was speaking more about the infrastructure money, the 3.7 billion or whatever.
We don't have, because of we meeting with the czars, as the mayor was saying, the money was going to fall out of the ceiling.
Right.
And now the air, that hasn't happened yet.
Okay. That's the one that Mayor Chavez and Bianca.
Mayor Chavez and Mike Hammond and
Yeah.
Matt Schmidt.
Yeah.
Well, I'm sorry. I know this is getting more conversational, but the time has come that we have to, I take a motion for adjournment on our work study.
So moved.
Thank you.
Second.
All right, we are adjourned. I want to thank everyone for coming. I think the information was really helpful.